Hello, welcome back guys. I hope you had a nice weekend. In this video we're going to be taking a look at DINO or HF Sinclair Corporation. And this has to do with oil and gas refining. As you'll see here is the industry. It's an energy sector company, and of course they are all the fast these days, and so a lot of people are actually wondering whether they are an interesting purchase. So in this video we're going to examine that and see whether buying this company could be an interesting opportunity. Now, from its 1-year high, this is down like 12%, yet lately it has been going up, and you can kind of see that already in the chart. If you take a look at the 6 months, you can see it a little bit more clearly. It has been at a peak at some point, then actually went down with the overall market, and then started going up again. And if you take a look at the 5-year chart, you will see a story of a company that goes up and down a lot, as expected. And this is a point that I really wanted to make about oil, for which I have talked about before in previous videos. Oil is an extremely cyclical industry, and you have to be super careful about owning it. You really want to be buying it when stock prices are going up and when the overall oil market actually is going up, and not really at the peak. So you can never really know when the peak is, but you can potentially see that the market is starting to cool off in some situations, and then you may be wanting to get rid of some. And the opposite thing should be happening when the stock prices are very low, and when the overall oil market is actually tumbling, as it was happening like 2 years ago. Then it's a nice opportunity to buy some oil stock, which is what I did actually back then, and I have talked about it in some videos in the past. Now, obviously there are a lot of these companies. What you do want to be doing is avoid the ones that have tons of debt. You really want to avoid the ones that have tons of debt, because they can go south very quickly. You want to be potentially getting some that have very little debt here, and the companies that their stock price has been affected significantly, so it can give you a nice potential entry here. And it hasn't enjoyed a super insane run really to the upside, which hasn't happened with this 1 year. Yes, it has been up, but not insanely up, like it hasn't even reached its 1-year high. But the point is, do we want to be buying this specific one? And this is what we're going to be examining in this video. Now, generally speaking, I don't recommend people to go full into oil, again, because it is very cyclical. It's I only consider these kinds of companies like trades, basically, that could last for 1 or 2 years potentially even, but not really for holding them for 10 years. This is, generally speaking, not a good idea for oil companies, unless maybe they are Exxon or something of that sort, and even then they will be having some downturns in the long run, no doubt about it. They're very cyclical, so it always pays to be potentially trading these ones than actually holding them for the long run. But let's examine this specific company here. You'll see that the P ratio is actually rather low here, and it's been going lower, meaning that the company is making enough net income to sustain its price, to make up for a price that is actually looking cheap. It's like 6 times its net income. So we will, of course, examine that in more detail, because the price to free cash flow is actually negative here. So what happened with the free cash flow is what we do need to see, and why we're getting in negative territory while net income is positive. Now, outstanding shares have also been going up, diluting shareholders basically in the last quarter is what the company has been doing, potentially because the stock price has started going up, and then they got some opportunity to actually issue some extra shares here. Now, again, the free cash flow has been negative, which is not a great thing to see, and the revenue has been growing, but not massively, because again, you're going to be having a company that's going up and down quite significantly because of the downturns and in the oil market that happen a lot. Those happen a lot. And so in terms of the net income growth, it has been in negative territory. Same thing with the free cash flow growth, which I believe is the most concerning thing, frankly. And in terms of the total equity, is growing a little bit, but remember, the company has been printing tons of shares here. This is why you're looking at this abruptly increasing. So in terms of the margins, about 7.5 to 8% over here, and the company doesn't seem to be having a lot of debt, at least compared to its equity, which is nice to see. However, we do need to be taking a little bit of a closer look at the total liabilities here, and potentially even the debt of the company. We're going to examine that in a little bit more detail. In terms of the dividend yield, 0.77, very little dividend that the company is paying right now, you will see. And the payout ratio is about 5.5% in terms of net income, free cash flow is negative, has been negative in last year, so this is why you're getting a negative value here. I always like to take a little bit of a look here at the dividends tab, see what's happening. It's actually, this is not regular dividends here, so it looks like it's like extra dividends, so we don't really have any dividend concerns for this one, and you wouldn't be expecting a regular dividend out of an oil company, really, that is a small one, unless it's maybe a company like Exxon. You can't really be expecting these companies to be paying you regular dividends, frankly, but they could be paying you special ones once in a while. Okay, so what about the financial statements? Let's see what happened. Now, revenue, you will see 14 billion, 17 here, and 11. So 2020 was a bad year for them. Again, with the overall oil company market, pretty much. Every oil company, lots of oil companies actually went default back in 2020. So you can understand that even making this kind of revenue is not bad at all for a company of this sort. In terms of the net income, from 800 million to about 700 here, 1 billion, minus 600 in 2020, again to be expected, and 550 in the last year. Now, the balance sheet of the company, what's going on there? I want to examine the total liabilities. This is very, very important. And also the long-term debt is frankly very, very important here, 3.3 billion it is. And in terms of the total liabilities, 5.6 billion is the total. 6.6 billion is the total, with the total equity at 6.2. But the additional paid in capital, remember the company issuing more shares. Now, you will notice here 6.6 billion in total liabilities. This is very, very important because it gives us a sense of what the company owes to potential suppliers, or also debt. Could be tons of different things, tons of different liabilities that are basically pretty much broken down here, the non-current and current liabilities. But we do want to have a sense of what the company owes pretty much in all its different outputs, pretty much. So in terms of cash flow, now this is where it gets important and interesting. The company had a positive net income here, but you will see a change in working capital that is in negative territory, and inventory that is in negative territory, and also in other non-cash items that these tend to be one-time expenses here that really affected the net cash from operating activities, while it should have been significantly higher here. This kind of increase, like the change in working capital, for example, basically what is working capital is the current assets minus current liabilities. So the company, for example, departed of some of its cash in order to potentially pay for receivables, for example. So they have some account payables, pretty much potentially, that could be affecting their change in working capital, or they actually added some extra inventory, and this is why they departed of some of their cash. This is why this cash is actually deducted here from its operating cash flow. And now you're getting to 406 million, which is very, very close to what they did in 2020, which was a bad year for them. So they kind of balance these things out. So why are we looking at negative free cash flow then? And the reason for this seems to be capital expenditures. So the company is expanding, so it's actually spending some money here. You will see spending in investments in property, plant, and equipment, which kind of tells me that the company could be looking to expand and actually think that they would be making quite some good money out of this, because you're not going to be likely to expand your business, especially in an oil corporation, if you are not expecting to be gaining your money back. And this is a pretty big investment here, and I'm assuming it's going to continue happening maybe in the next year or so. So from what I'm seeing here, even though we're looking at negative free cash flow, I kind of like this the reasoning behind it. It is not necessarily a bad thing. What I'm saying here is what I'm saying. Now, of course, again, remember, very, very cyclical market. If this kind of trend continues with the energy, then this company will likely prosper and do much better even in the next few years. So yeah, what I'm seeing here is definitely not forbidding me from entering this company as I'm seeing its financials here. Even though again we're looking at negative free cash flow, there may be a reason, and in this case there is a reason. So this is why it's important to be examining the financial statements, because they tell a story. And the next thing is actual stock evaluation tool. Now, again, evaluating these companies that are super cyclical can be very, very tough to do, because take a look at the revenue growth. This has been all over the place, understandably, because the company goes up and down a lot in terms of what they're doing in revenue. It's an oil company. And so what you could be doing is getting the average here, the 5-year growth. And we are expecting that the market is, generally speaking, going to potentially go upwards in the next 1 or 2 years, probably that is, again, I'm saying, but we're going to go low, 8, 10, and for the high one, I'm going to be using a little bit of a more aggressive one, 14, in the case that oil continues to be an important thing for for the overall market, and actually is still a very, very expensive thing. It's always going to be important, but will it be as expensive as it is right now is the question, or its price is going to go down. Oil, generally speaking, tends to come down quite quickly after it has its its years or months where it's actually trending higher. But at the current situation, the current climate, economic environment, it may stall a little bit, may last a little bit longer. Okay, so in terms of net income margins, again, the company, you can kind of get an average here, 2.7. Again, remember, this is going to be up and down a lot. I'm going to be using 2, 3, and 4 here. And the free cash flow margin, likewise, it's going to be up and down a lot, but for a reason. I mean, the company has been spending a ton, it looks like, in capital expenditures, so I would kind of exclude this year. And last year was actually a year that was the odd one out. The company didn't do very well. And of course, you have the years where the company did very well. And so again, because of this, of the cyclical tendencies of this market, you're going to be having an all over the place free cash flow growth and margin here. And so you are looking at about probably maybe 80 to 90% is the typical expectations. But in terms of how free cash flow is growing and potentially with the margins, you will be all over the place with these kinds of companies. Now, 13% for our annual return here, you may be asking for a little bit more in some situations, again, especially because this is a little bit of a riskier one. And if you hit calculate, you're getting that it's our high estimate that is a buy price right now with a current price of $51. And our medium one is fairly close as well, with our low one being at $24.7. Now, would I be buying this company? Well, even though you are looking at red numbers here, this is again not a company to be buying for the long run. It's more like a trading play, more like a cyclical play. So I could definitely see myself potentially adding some to my portfolio, but I wouldn't go overboard. These are not companies to be holding for the long run. These are companies to be taking advantage of as the markets are actually trending in terms of oil. So it may be an interesting opportunity to actually buy a little bit, but again, I wouldn't overdo it. The usual fundamentals that are at play with most companies are going to be subjective to a lot of discrepancies here in these kinds of companies. So again, you want to be taking this with a little bit of a grain of salt and just be very, very careful about these kinds of companies. But for a for a trade, for a sort of like mid-term trade where you hold it for maybe 6 months to a year or something of that sort, and then capitalize on the gains, it may be an interesting opportunity. But let me know what you think about this company. Remember to leave a like and subscribe, and leave a comment below. I'd love to hear your opinion about oil and this potential acquisition here, this company, for a portfolio. So thanks for watching, and I'll see you in the next one. Bye bye.